The Federal Reserve just dropped a major hint. Interest rate cuts could be on the horizon. While the move might offer relief for borrowers, it's sparking debate across the financial and political spectrum, especially from former President Trump, who's urging for faster, deeper cuts. He argues that lower rates will help curb the cost of the national debt and boost American industry. But behind the headlines, there's a deeper story affecting everyday Americans. Whether you're carrying credit card debt, saving for retirement, or budgeting for rising grocery bills, these decisions could hit your finances in real, personal ways. In this breakdown, we'll explore what the Fed's next steps might look like, why Trump is pushing back, and, most importantly, how all of this could impact your borrowing costs, savings returns, and long-term financial plans. Let's dive into the tug-of-war and what it means for your money. Setting the stage, the Fed's cautious strategy. To start, let's clarify what the Federal Reserve actually does. The Fed is America's central bank, and among its main tools is something called the federal funds rate. This is the rate at which banks lend money to each other overnight, but it acts like a ripple across the whole economy. When the Fed raises or lowers this rate, it influences everything from credit card interest to mortgage rates, business loans, and the returns you earn on savings accounts or CDs. Right now, the Fed has been taking a very cautious stance. Inflation has cooled from the highs we saw in 2022 and 2023, but it hasn't dropped low enough for them to feel confident about aggressively cutting rates. At their last meeting, they decided to hold rates steady, but hinted that a small cut, maybe around half a percentage point, could come later this year if inflation continues to trend down. This approach is what you might call a measured tap on the brakes. They don't want to move too fast and risk reigniting inflation, especially with global tensions, domestic supply chain issues, and labor market shifts still creating uncertainty. Trump's push for fast, deep cuts. Now enter Donald Trump. The former president has made no secret of his dissatisfaction with the Fed's pace. He's gone so far as to criticize Fed Chair Jerome Powell directly, blaming him for not cutting rates sooner, and accusing the Fed of costing Americans billions in unnecessary interest payments. Trump's reasoning on the surface is simple. Lower rates would make it cheaper for the U.S. government to borrow money, which is crucial given the staggering $36 trillion national debt. Beyond that, Trump argues that rate cuts would help revive domestic manufacturing, reduce costs for businesses, and stimulate consumer spending. All helpful optics heading into election season. But here's the twist. While Trump's call for lower rates is politically advantageous, cheaper debt, boosted economic activity, and a friendlier financial climate for business, it could actually backfire in the long run if not managed carefully. The 1970s. Flashback. Why the Fed is nervous. To understand the Fed's caution, we have to look back. The 1970s serve as a cautionary tale. Back then, the U.S. experienced what economists call stagflation, a rare and nasty combination of stagnant economic growth, high unemployment, and skyrocketing inflation. A big part of that spike came from the 1973 oil crisis, when OPEC drastically cut oil supplies, sending energy prices through the roof. Today, while we're not in a 1970s-style crisis yet, some patterns are eerily familiar. Oil prices are once again volatile, in part due to tensions in the Middle East, especially recent escalations between Israel and Iran. Add to that Trump-era tariffs on imported goods like steel and aluminum, and you have a recipe for inflationary pressure. Tariffs make imported goods more expensive, which means manufacturers either eat the cost or pass it on to you, the consumer. That's part of why the Fed is wary of unleashing a flood of cheap money into the system. If inflation reignites, they might be forced to hike rates again soon after cutting them. an economic whiplash scenario no one wants. Immigration and labor shortages. The silent price pressures. Another piece of this complex puzzle is immigration, and this one doesn't get enough attention. Trump's stricter immigration policies, particularly around low-wage labor, have led to labor shortages in key industries like agriculture and construction. When there aren't enough workers to pick crops, build homes, or manage warehouses, companies have to raise wages to attract help. Now, rising wages sound great, and they can be, especially for workers who've been underpaid for years. But they also come with consequences. Businesses often offset higher payroll costs by raising prices. That's how a worker shortage quietly fuels inflation over time. For example, fewer field workers mean farms pay more to harvest crops. That cost trickles down to your grocery bill. It's not always as noticeable as gas prices, but over months and years, you definitely feel it. So, what does this mean for you? Let's get practical. If the Fed does proceed with modest rate cuts this year, here's what you might expect. Borrowing could get slightly cheaper. Credit card interest rates, which have been hovering around 20% for many users, could dip slightly. Mortgages and car loans might see a small drop, though not dramatic. If you're looking to refinance your home, it could soon become a little more attractive. But don't expect a huge plunge overnight. Savings accounts could take a hit. High-yield savings accounts are currently offering returns near 5%, which is pretty generous compared to a few years ago. But if rates drop, banks will start trimming those payouts. For retirees, this matters a lot. If you rely on interest income from savings or CDs to supplement Social Security, even a 1% drop in rates could mean hundreds or thousands of dollars less per year. National debt, a double-edged sword. Let's revisit the debt angle. Trump argues that lowering rates would help reduce how much the government pays in interest on the $36 trillion national debt. And he's not wrong, in theory. But here's the catch. Investors who buy U.S. Treasury bonds aren't just looking at the Fed. They're looking at America's fiscal health. If they see rising debt without a clear plan for repayment, they start demanding higher yields on bonds. That means long-term interest rates, like those tied to 30-year mortgages, could climb even if the Fed cuts short-term rates. It's a bit of a paradox. The government tries to save money by cutting rates, but if global investors get spooked, it might end up paying more in the long run. Smart moves to consider right now. So what can you do in the face of all this economic push and pull? Here are some actionable steps. 1. Lock in a high-yield CD. Now rates are still attractive for short-term CDs, 6 to 12 months. So if you've got some idle cash, it might be smart to lock in now before rates start slipping. 2. Refinance strategically. Keep an eye on bond yields, not just the Fed's announcements. If mortgage rates drop 1/4 or 0.5%, it might be worth refinancing, but move quickly. Lenders often adjust offers rapidly when the Fed shifts course. 3. Reevaluate your savings strategy. For seniors, consider laddering CDs, staggering maturity dates, or exploring other conservative income-generating investments. Talk to a financial advisor about municipal bonds, annuities, or dividend-paying stocks, with a focus on low risk. 4th, plan for inflation uncertainty. If inflation resurges, your cost of living adjustment from Social Security might not fully keep up. So factor in a what-if scenario, higher prices with lower returns. Adjust your household budget or explore supplemental income streams if needed. Final thoughts. Don't chase headlines. Prepare proactively to wrap it all up. The Fed and Donald Trump are essentially arm wrestling over how cheap money should be right now. One side wants caution and stability. The other wants bold moves and immediate relief. Both have legitimate concerns, but in the end, it's ordinary people like us who feel the real impact first. Your savings account, your loans, your retirement budget. These aren't just lines on a spreadsheet. They shape your day-to-day life. So don't get lost in the headlines or overwhelmed by political drama. Take control where you can, stay informed, and make small, smart financial moves that keep you ahead of the curve.